The hype on social media right now is telling you that May 1st, 2026 is the day American credit changes forever, that a reset button has been pressed. That is not what happened. There is no reset. There is no May 1st deadline, but there are three real changes that have already happened. One of them just 9 days ago, and they are quietly reshaping how lenders look at your file. If you do not know what they are, you are going to walk into a loan application and find out the hard way that the rules moved without you. Today, I am breaking down what actually changed and what it means at the underwriting desk. Welcome back to Sense and Simplicity. If you are new here, I spent over 20 years in banking across major banks, regional banks, community banks, and a credit union as a branch manager and a district manager. So when I tell you what these changes mean inside a lender's office, I am telling you what I watched the underwriting decision look like for 2 decades. Some of what I cover today, the FICO model adoption timeline, the federal court ruling on medical debt, and the buy now, pay later reporting agreements, comes from sourced research, not personal experience. Sources are listed in the description. This video is for general informational and educational purposes only. Before we get into it, let me tell you what is not happening. There is no May 1st reset. There is no overnight wipe. Nobody is going to wake up on May 1st with a higher score because of a calendar date. What is happening is slower, quieter, and more important than a reset. 3 separate shifts from 3 different sources that all change how lenders read your file. One came from a federal court, one came from a credit scoring company, one came from a federal agency just 9 days ago. We are going to count them down. Number 3, medical debt. Number 2, buy now, pay later. Number 1 landed on April 22nd. Number 3, medical debt. And this is where most of the social media coverage is wrong. You may have heard medical debt is being removed from credit reports. That is partially true and partially false. The federal rule that would have removed all medical debt, the rule the Consumer Financial Protection Bureau finalized in January 2025, was vacated by a federal court in July of 2025. A judge in the Eastern District of Texas ruled the CFPB exceeded its authority. That federal rule is dead. It is not coming back. So what is actually still in place? 3 things. 1. The voluntary changes the 3 major credit bureaus made in 2022 and 2023. Paid medical collections are off your report. Unpaid medical collections under $500 are not reported, and there is a 1-year grace period before unpaid medical debt over $500 hits your report. 2. 15 states have their own laws restricting medical debt reporting. California, New York, Colorado, Illinois, Washington, and 10 others. 3. Newer credit scoring models weigh medical debt less heavily than older models did. Number 2. Buy, now pay later. Klarna, Affirm, Afterpay, Sezzle, PayPal, Pay Later. The split it into 4 payment services that have exploded over the last 5 years. Here is what actually changed. In June of 2025, FICO announced the FICO score. 10 Suite would include buy now, pay later data. Affirm started reporting pay in 4 loans to Experian on April 1st, 2025, and to TransUnion on May 1st. That data is now on millions of credit reports and factored into the newest FICO models. But here is the part the social media coverage is leaving out. Klarna and Afterpay declined to participate in FICO's buy now, pay later scoring model. That is a critical detail. If you have used Affirm, your buy now, pay later activity is on your file. If you have used Klarna or Afterpay, it is mostly not, at least not yet. Which provider you used matters. At the underwriting desk, when buy now, pay later does show up, we see 5 or 6 short-term installment loans open at the same time, all under $1,000. To an underwriter, that pattern reads 2 ways. Either you are managing small obligations responsibly, or you are stacking small loans because cash flow is tight. The second read costs you on auto and personal loan applications. Number 1. And this is the change everyone should actually be paying attention to. On April 22nd, 2026, 9 days ago, the Federal Housing Finance Agency and the Department of Housing and Urban Development made a joint announcement. Fannie Mae, Freddie Mac, and the Federal Housing Administration are now accepting 2 new credit scoring models for mortgage underwriting: VantageScore 4.0 and FICO Score 10T. This is the biggest change to mortgage credit scoring in over 30 years. Classic FICO, the model that has decided who gets a mortgage since the early 1990s, is no longer the only option. So, what makes 10T different? One word: trended. Classic FICO took a snapshot of your file. What is your balance today? Did you pay on time? What is your utilization right now? 10T looks at 24 months of history. It can see whether your balances have been climbing or falling. It can see patterns. Classic FICO simply could not see. Two specific behaviors get rewarded: consistent paydown over time and a clean, stable utilization pattern. Two get penalized: carrying a high balance month after month, and the spike in paydown pattern. The one-time paydown right before a statement closes does not work the way it used to. The April 22nd announcement did not flip a switch, it opened a door. VantageScore 4.0 is available immediately for approved lenders on conventional loans sold to Fannie Mae and Freddie Mac. FICO 10T historical data publishes in the summer of 2026, with broader adoption following into 2027. 40 mortgage lenders are already in the FICO 10T adopter program. 7 of the 10 largest mortgage lenders in the United States are evaluating it in live production right now. For credit cards, auto loans, and personal loans, adoption is uneven and slower. Here is what it means at the consumer level. If you are applying for a mortgage in the second half of 2026 or in 2027, your lender may pull a different score than you have been tracking on your free credit monitoring app. The scores can differ by 20 or 30 points. The version of your file the underwriter sees is not always the version you see. For credit cards and auto loans in the next 12 months, older FICO models are still mostly in use, but the trended data scoring is coming. Here's the trap most people miss. 2 of these 3 changes are working in opposite directions. Medical debt is becoming less powerful in your credit profile. Buy now, pay later is becoming more powerful. So if you have been treating buy now, pay later like free money because it does not show up on your credit report, that assumption is now wrong. And if you have been ignoring an old medical bill because you heard it cannot hurt your credit, that may also be wrong, depending on your state and the size of the debt. If you have unpaid medical debt over $500 that is more than 1 year old, that debt can hit your credit report. If you have used a firm in the last 12 months, your activity is now on your credit file. If you are applying for a mortgage in the next 12 to 18 months, ask your lender directly which credit scoring model they are using. The answer matters. You can pull your credit report for free once a week through the official bureaus or through any free credit monitoring app. Here are the 3 non-negotiables that work under Classic FICO 10T, VantageScore 4.0, and any model that comes next. 1. Pay on time, every month. Payment history is the largest single factor in every major scoring model, and that is not changing. 2. Keep utilization low and stable, not just on statement close day, all month. The trended models can see the spikes. 3. Do not open accounts you do not need. Every new account drops your average age of credit, and 10T weighs age of credit more transparently than the older models did. If you want to see what actually changed on your file, here is the order to check. First, pull your credit report from all 3 bureaus. Look for buy, now pay later accounts and any medical collections you assumed were removed. Second, ask your existing lenders which scoring model they are using. Most will tell you if you ask. Third, if you are within 12 months of a major loan application, talk to a licensed financial professional about which model your file scores best under. Your action step this week: pull your credit report. Look for buy now, pay later accounts and medical collections. Confirm what is actually on your file before the next time you apply for credit. The cost is 0. The information is yours by federal law. The reason these 3 changes matter is not any one of them in isolation. It is that lenders are getting more data, sharper data, and more accurate data than they have ever had. The era of the static credit snapshot is ending. The era of trended, behavioral, multi-source scoring has started. Subscribe for more real banking insight from a former branch and district manager. And remember, the credit system always rewards consistency over hacks. Now, more than ever. I will see you in the next video.